Okay, perfect. So we're going to kick things off. So excited to have all of you here with us today for our small Ask Me Anything on navigating the pre-seed and seed landscape in Canada. Some quick house items just before jumping into the presentation. As we went over, the format of the structure is essentially our speaker will be spending the first 15 to 20 minutes taking us through kind of navigating the landscape in Canada. We will be recording this part of the workshop. After the presentation is over, I'll be stopping the recording, and that's when we're actually going to shift over more into our Ask Me Anything format. This is where all of you will have the opportunity not only to ask Eugene any questions that you may have through his presentation, but anything that just may be on your mind. And of course, this is also an opportunity for you to get to ask the collective group anything. Nahela and I really wanted to keep this to be a small, intimate group of between around 10 to 15 founders just to talk about their experiences fundraising. I think we can all say that fundraising is never an easy process, and now here we are in this pandemic world where there have definitely been some pros and cons to what's really happened in the venture capital pre-seed landscape. So we won't be recording that section. I also just ask as we do go to that section, obviously we can't force you, but just to really help kind of build that level of community and engagement, if you wanted to turn on your camera when we do get to that section, I think it really does help just in terms of helping to facilitate dialogue. With that said, that's really enough for me. I'd now like to pass the floor over to our speaker for the first part of this section. He's one of our entrepreneurs in residence, Eugene Bomba. He works at PwC. I think for all of you who have gotten the opportunity to work with him before, he's been such an invaluable resource to have at the DMZ just in terms of navigating the trials and tribulations of fundraising. And we're really excited to be able to welcome him here this afternoon to present to all of you. So Eugene, once again, that's enough for me. Over to you. And once again, thank you so much for lending us some time to talk about this today.
Awesome. Thanks, Shane. Now, I've spoken with a lot of the folks who are on right now. So I'm going to try to keep the slides down to 15 minutes here. I really wanted to get a little bit more in terms of the weeds and let's roll up our sleeves and chat a little bit more on what you're experiencing, everyone, on your fundraising journey right now, and how we can help one another, and where I can help you. But the adage of takes a village to raise a child is no different when it comes to startups and everyone else that kind of needs to be supportive here. So it is a safe space. We're all nobody's competing with one another on here. So let's also keep that in mind and keep the questions kind of coming through, and Shane can help in that regard as well. So quickly on the Canadian landscape right now, obviously with how things have kind of gone on with the pandemic, there was a slowdown on the VC financing side and on just rounds in general, but that's gone. I think anybody who's giving you that as a reason now as your fundraising is just in a kind way telling you no more than anything else. There is no pandemic slowdown anymore. So hockey stick and the CDCA put out something recently on Q3 activity. So sure, levels are slightly down, but there are deals that are happening. We were on, things were just on a crazy high up until the pandemic, but you can even see in Q2, like there was, deals got invested in Q2 mainly because of follow-on rounds, I would say, and people and the funds just ensuring. So that was probably true when you're out fundraising at that time, or if you were starting to have any conversations with people, that any institution was basically like, hold off, I'm not doing new deals unless I was already kind of working on one beforehand. But I need to make sure my existing portfolio has enough capital. So people played around with their reserves and did some funny things then. But Q3, since the summer, so I'd say like really since July, I've seen deals like flying through. There is no shortage of deal flow activity for investors right now. Canadian landscape wise, things are busy, it's where you would expect to see the activity. So a lot of activity across the major areas. Atlantic Canada stands out just as a number only because of the Verafin deal before the announcement of the exit just recently. But otherwise, that deal was like 45 deals for like 80 or $90 million, which is still pretty healthy. But needless to say, again, everybody's getting deals done across the country. So this is by no means all inclusive. This is a big snapshot of the funds that you would expect to see across. And I know it was one of the questions that was kind of raised of who do you approach. There's definitely some homework to do from that point of view. Who is in on other rounds? The good thing is that even if you use something like, you can subscribe to Hockey Stick, you can subscribe. I find Crunchbase is really good as well. You can see who went in on rounds of companies that are similar, right? Even if you're looking in for companies that are a few years ahead, but they sometimes will disclose who their seed or pre-seed investors are. You can generally get a sense, from a Canadian point of view, it's easy because you can look up the portfolios, same thing with the US, but sometimes on the seed and pre-seed, you can find some of the more obscure funds that are harder to find or harder to acknowledge. And those are the ones where there is still a gap, I think, that you have to be prepared for and understanding in this ecosystem. So if we, keeping as a focus on this slide for a second, you'll have some of your accelerator and incubator type of funds, right? So N49P as part of the AngelList piece with Alex Norman is a good one. DMZ Ventures, obviously. 500 Startups is another one. Techstars, like you get into those like early accelerator type funds, and then you also have some of the more pre-seed focused funds. So someone like a Mistral Venture Partners, Mars IF, like those earlier stage ones. Union Capital isn't on this list, but Union Capital would be another one. What you're finding right now in Canada is funds are getting bigger, right? And you've seen this in the US as well. So as funds get bigger, so let's say it's $100 million, like there's a lot of $100 million funds in Canada. Those funds typically started off as seed funds or pre-seed funds. And then, let's say they start off as seed funds. They start needing to write bigger check sizes as the funds get larger because otherwise the economics don't work. So they can't write these $500,000, to 750K or $1 million checks when the fund is above $100 million. There's just not enough capital for them to be able to deploy in that scenario where they're picking a select few deals and where they can then say, okay, I'm going to play heavier in the second round or the follow-on rounds. So as they get to that $100 million range, more of them are looking for the late, now, we get seed and variation. So call like a late seed or an early Series A, which is like the lower end of that Series A range in that $3 million range. People start playing at that size. So what I'm seeing in this landscape is pre-seed and early seed. There are still less and less investors from an institutional point of view. So it's once again leaning towards, picking your spot ultimately, that if you need to raise that bigger chunk of money, sometimes, people are still finding some success with angels, but there's some drawbacks that way as well. Or, you're doing some smaller rounds, like Panache is making a lot of small bets, following with the 500 startup mentality. Mentella is another good group, but they do very few deals. So like you can find that sweet spot with some of the smaller funds, but there is definitely a gap right now that you need to be aware of as you're raising. Most people said they're raising between $500,000 to $1 million on this call. That is almost like, it's not a death call, but like you're basically in like a real tweener type of zone, right? So pre-seed tends to be in that $500,000 range, and you're ending up looking at more angels, super angels, like high net worth individuals. And then seed is now kind of in this like, million, million and a half. I'd say million to like $3 million is like a good seed size now. So that $500,000 to $1 million puts you in a bit of a tweener zone, where are you pre-seed or are you seed? And determining that is really a hard look at where you are with your product, as well as, you know, what dilution you're willing to kind of look at. So we can come back to this list again as we're talking more of the questions, and we can get into a little bit more in terms of what some of the funds have to offer, and you know, what we can do to kind of help you self-select or shortlist where you think you should be looking next. So everyone on this call has raised some money, but the real basics of friends and family versus angels and VCs and debt are in here. We know most of this. I tossed it in as a general slide in case, but I'm pretty sure everyone on here already knows these categories. Let's talk about what we're seeing though in terms of rounds. So again, pre-seed, I'd say, you know, most people are kind of saying, okay, where's the MVP at? Pre-seed has shifted, again, where people want to see some form of validation. So it's not like, hey, I'm building out. Let's call that now, that's more considered a friends and family type of round or a close round. When you're doing a pre-seed, you're talking about angels. It's going to be people that you don't necessarily know closely when you're thinking about that pre-seed round, and there has to be some market traction or market validation. In the US, you might find some people who are willing to take some more flyers if you're starting to find that your customer base is in the US and you're starting to see some, you know, you're looking more like a US deal. But generally speaking, in a Canadian landscape, you need to have some evidence of traction, even in this pre-seed zone. With the institutional investors, they will not make a bet on a win. Most of them are looking to see something that says that you're in the right kind of marketplace. So it could be some revenue, it could be some real high usage between the existing users, but you're looking for something that says I've got what looks to be the early stages of a successful company in the build. So if you're building a marketplace type of company, you at least have one side of the marketplace showing a lot of interest, where then it's like, okay, now, you know, it's going to be some work to get to the other side, but, you know, we are getting good pickup on the one side. If you're selling, you know, if it's an enterprise type of account, are you starting to see some POCs or early customers showing up? And with the early customers, what's the usage starting to look like? It's really, it's not an easy bar, but it's something that, again, whether it's more of a conservative nature on the Canadian side, or the fact that a lot of the Canadian VCs are not operational before, that they're all looking for some validation point. On the when you get into the angel side of pre-seed, and I know, again, I've had this experience with a few of you on the call, the angels are asking almost for even more at this stage. So they're pretty clear cut on some of these things, where they're looking for a lot more traction and a lot more revenue at that same investment size. So a lot of the angels I find you have to get them involved in some of the conversations, sometimes just to hone the pitch. But the expectation is no different with the angels. I find that they're almost harder in a certain way, just because they are asking for what I would typically expect most seed investors to be asking for, but they're writing checks at the pre-seed level. So there's a bit of a mismatch that you need to manage if you're raising with that group at that level. On the seed side, generally, if it's a subscription type business, I'm seeing most seed deals happening where people are doing like 30K in MRR. That seems to be the sweet spot right now from a seed perspective. It could be, you know, up to 50K MRR, but it's kind of in that zone. I haven't seen as much happening pre-30, to be honest. So again, if you start thinking about that from a valuation point of view, everybody, all these rounds and all these terms ultimately comes back to dilution and reverse engineering what the value is. So, you know, there's a bit of a hang up on what's the value of my company. The value of your company is a function of how much money you need and what you're willing to give up. There isn't a, oh, you know, this person thinks I'm worth 5 and someone else thinks I'm worth 8. Someone thinks I'm worth 10. It's, I need, you know, from a simplicity point of view, let's say you're looking for $2 million as a number. You know that the VC or the institutional investor is looking for about 20%. That is kind of your rule of thumb to be basing all your decisions on, is assume 20%. You might be able to get somebody down to 15, 16. Somebody else might come in higher and try to get to 25. But 20 is a good rule of thumb number to keep in your mind, given the current traction. So if you're raising your round at 20, let's say, you know, in the $2 million example, your valuation is going to be somewhere between, you know, call it $6 and $8 million on a pre-money number, right? So if you think of like, okay, how does that work? $2 million on 6, right? But then that gets me to an $8 million post-money valuation, would get me to 2 million divided by 8 million, get you to 25% for the investor. Or, okay, $2 million example still, if pre-money was 8, that means that you're 2 divided by 10, which gets you to the 20% number. So that is, like, generally speaking with the VCs, that's what they look at. And then they might rationalize the valuation on you based on a revenue multiple and, like, if, you know, other things kind of stick together. But the starting point is their percentage of ownership. And if you're asking more than one VC to come in, they both need to have a certain amount, right? Some of them actually have in their LP agreements that they need to have a minimum of 8 or a minimum of 10% if they're going to syndicate a deal. In which case, you know, you need to also keep that in mind. There isn't that much wiggle room potentially on the valuation that they're going to offer you if you want more than one person coming in. But that being said, like, as you're thinking about the dollars and the valuation, think of it more about, like, you really have to have a good viewpoint on your use of proceeds. It is, you know, it's the hard disciplined work of, like, what will I, you know, how much money do I need? What do I need it for? And how long is it going to last me if I raise this money? In today's environment, most of the funds are looking for a 2-year view of the money, understanding it might get to, you know, 18 months of a view, but they want to see that the company will spend it over 2 years, which was different than, you know, pre-pandemic. You probably had to show you would spend the money through 18 months so that by month 12 to 14, you'd be back out in market, at least going through the conversations to raise your next round. So you need to stretch your dollar a little bit further in today's environment as you're thinking about how much money I need to raise and relative to the stage as well. And we can talk about some of the pitfalls again in a little bit as you go. The other piece of that you can see here is there's always, I think it's a little different where, again, people had an older view sometimes where pre-seed and seed, like, the thing I think I want people to take away from this is there has to be sales traction or something on a sales support point of view, unless you're building, like, real deep tech where it's like, okay, you're not going to see revenue for a little while because I'm doing something in R&D of some sort where it's a little different, or sustainability potentially. But in general, subscription or marketplace type of businesses, you need to have revenue. And even so pre-seed, at seed, there is no getting around that view of traction. And in your use of proceeds, even from a pre-seed perspective, the expectation is that there's some revenue and you're going to be investing to earn more revenue. The money is not just for R&D. If you put that into your mix in your slides, it's not going to get the institutional investors. You might get an angel, but you're not going to get the institutions involved unless there's upside spend being made. Other than that, so we talked, you know, I think we all know about the ownership side of things. Percentages, again, it's slightly skewed. Sometimes the conversation has come around about whether I should be doing a debenture, whether I should be doing a SAFE, whether I should be doing a priced round. You know, the answer is it depends. But there is the reason for it is about speed. of getting your round done. No, like there's a preconceived conversation or notion out there of I want to do a safe or a note because I can't agree on the valuation. It's a cop out, and it's not true, because every note and every safe now has a cap on the terms, which basically sets the valuation for the investor in the best case scenario, where you're growing well beyond when you raise your next round. They're going to get their equity at a priced round based on that cap. So if they set the cap at $6 million, and you're like, hey, I'm going to do better than that on the next round, it's like, well, great, but my cap is still 6. So they're still going to get their 20% at the 6 million, even if you're raising your next round at 15 or 20, as an example. So this notion of we can't agree on valuation, it's all noise. The only reason to do it is about speed and simplicity. So if that's the case, and I'm not a huge fan personally of doubling up your series on safes and debentures, because you hide your dilution in there a little bit, and it looks really dilutive when you actually do raise your equity round. But beyond that, it's really think about pricing around for preps versus doing a safe or debenture. There's not much upside aside from the cost is what's different. So you got to think about that as you're raising. And then again, we could talk a little bit more about that. Other than that, let's get into some of the other questions that people have had and have a little bit more of a discussion if you guys are okay with that.
Okay, perfect. Thanks, Eugene. So and thank you for everyone who's watching this video in the future, but now is when we will end the recording. So thank you for watching again.